Palantir stock is down 15% this year. But the underlying business is doing the exact opposite. Revenue is up 56%, return on invested capital is 136%. So is the sell-off a buying opportunity or is the valuation still the problem? Morningstar rates Palantir a narrow moat, built on two sources, switching costs and intangible assets. The core of Palantir's business is its ontology framework. Think of it as the operating system for an organization's data. Palantir doesn't just gather data, it cleans it, identifies hidden relationships, and deploys machine learning algorithms that derive real-world operational insights. Then it builds a dashboard that continually learns and improves. Once these systems are embedded into operations, switching away means losing that edge entirely. The average Palantir customer spends over $1 million per quarter on the software. They have sunk monetary, intellectual, and data capital into the platform. Switching often doesn't make sense. To make this concrete, Palantir's software was critical to the intelligence framework used to capture Osama bin Laden. Tampa General Hospital partnered with Palantir and reduced patient length of stay by 30%. When the problems being solved involve human lives, institutions rely on the most robust solutions available. Switching away from that creates both monetary and immeasurable human cost. The net revenue retention rate, which measures customer expansion, sits at approximately 150%, the highest in its peer group across comparable data software companies. That said, there's a real competitive risk developing. AI labs like OpenAI and Anthropic are attempting to copy Palantir's deployment strategy. The declining cost of AI inference could lower barriers to entry over time. Palantir has a 10 to 20 year head start, and its governance layers create advantages AI labs currently can't match. But this is a real competitive watch point, not a theoretical one. Every data point in this video came from Fiscal.ai, the platform I use for every stock analysis on this channel. Link in the description for 15% off. Returns on capital tell us how efficiently management converts invested dollars into real profit. And the growth numbers coming next are where Palantir's story gets extraordinary. Palantir went public in 2020, so I'm showing data since 2018 where available. The trajectory is one of the most dramatic in enterprise software, from deeply negative return on invested capital in 2018 through break-even and now all the way to 136.5%. That's not just an improvement, that's one of the strongest return on invested capital profiles in the entire technology sector. Microsoft is at 23.9%, declining in recent years as AI capital expenditures weighs on returns. ServiceNow and Palo Alto are materially lower, but Palantir sits at 136.5% in a completely different category. Now on return on equity. Microsoft generates a 33.3% return, ServiceNow remains relatively stable in the mid-teens, while Palo Alto has seen returns compress sharply. But Palantir is now delivering a 26% return with a rapidly improving trend. The returns picture is exceptional and improving. Now let's look at whether growth justifies it. Growth is the engine that drives long-term value creation, and for Palantir, the numbers are extraordinary. Since 2018, revenue has grown at a compounded annual growth rate of 33.4%. I can't compute a net income CAGR over the full period due to early losses, but since turning profitable in 2023, the numbers accelerate sharply. Revenue has grown at a CAGR of 41.8% from 2023 through 2025. Net income has grown at a CAGR of 173.8% over the same period. These are not rounding errors. Earnings per share growth over 3 years is slightly lower at 164.2% due to share dilution of roughly 5% per year. Worth noting, but negligible relative to the underlying growth trajectory. Looking forward, analyst estimates show earnings per share growing from $0.6 in 2025 to $3 by 2028, a projected CAGR of 67.9%. What's driving this? Two things. First is US commercial growth. US commercial revenue grew over 133.3% year over year in the most recent quarter. Palantir's bootcamp sales model, where the company builds a tailored solution live in front of potential customers, has dramatically accelerated customer acquisition. The second is government spending. The Golden Dome US missile defense system, the Department of Government Efficiency, also known as DOGE, and a potential $1 trillion plus national security budget are all meaningful tailwinds for Palantir's government segment. And Palantir is one of the few companies operating at scale in AI-powered national security software. The growth story is compelling, but high-growth companies can still fall apart if the balance sheet is weak. So before we tackle valuation, let's see whether Palantir has the financial strength to support this expansion. Financial strength is our sleep at night factor. Total cash and cash equivalents is $7.2 billion. Total debt is $0.2 billion. Palantir can cover its entire debt more than 36 times over with cash on hand. Free cash flow is $2.1 billion, giving a free cash flow to debt ratio of 1,050%, where the minimum threshold is 10%. Palantir's financial strength is outstanding. The valuation section is up next, and this is where the analysis gets uncomfortable. Palantir trades at a forward price to earnings of 91. In historical context, the minimum was 31.3, median was 86.3, maximum was 252.1. Palantir is trading around its historical median, which sounds reasonable until you compare it to peers. Microsoft is at 23.1, ServiceNow at 25.1, and Palo Alto at 71.1. Palantir at 91 is the most expensive in the peer group on a forward PE basis, despite peers like Microsoft having stronger moats and longer track records. Now the price to earnings growth ratio, because PE alone ignores growth. The long-term analyst earnings per share growth estimate for Palantir is 45.9%. Based on a forward PE of 91, that gives a PAG ratio of roughly 2. Below 1 points to undervaluation, between 1 and 1.5 is fair for quality companies, and above 1.5 is expensive. At 2, Palantir is firmly in expensive territory. The honest caveat is that Palantir has consistently beaten analyst growth estimates, and Morningstar's bull case scenario implies a valuation of $300 per share if total addressable market penetration exceeds expectations. But for long-term investors, a PAG ratio near 2 leaves very little margin of safety. Let's bring it all together through our 5 key factors. Palantir has a narrow moat, built on switching costs from its ontology framework and intangible assets from its 10 to 20 year head start in AI decision-making software. Returns on capital are exceptional. 136.5% return on invested capital, the strongest in this peer group and comparable to NVIDIA. Growth is extraordinary. 41.8% revenue CAGR since profitability. Financial strength is outstanding, with a free cash flow to total debt ratio of 1,050%. But at a forward PE of 91 and a PAG ratio of roughly 2, Palantir is expensive relative to growth. Palantir may be one of the best AI businesses in the market today. But even great companies can become poor investments when expectations outrun reality. Is the 15% pullback the entry point you've been waiting for, or is the valuation still the problem? Let me know in the comments.